getting, are you getting comfortable and acclimated to the types of fluctuations and trends that happen in the market? And what are you seeing as you're entering this space?
Yeah, I mean, for Safe Harbor, we have to treat lending, as a traditional commercial lender, right? So we're looking for the right assets in the right market. And to some of the points brought up here, not only does it matter, how sophisticated the borrower is, what their cash flows look like, how much we know about them in the market. It's also market specific, right? I mean, if we get approached for a cultivation facility in Oklahoma, as opposed to, a cultivation facility in a state like Utah where there are 8 total, we're going to be less likely to do something in a market like Oklahoma for obvious reasons. So I think, for us, we're lending probably, in our chief lending officer is back there in the corner. Dan, raise your hand. I think we're lending about $20 million a quarter right now. And we've really focused on limited license markets. We feel very bullish about retail, and we've been able to find some really qualified operators, and we feel very comfortable with that exposure.
Great. Ben, I'm gonna pull on some of your data knowledge here. We had talked a little bit about pricing corrections, merger and acquisition activity. How do those things impact valuation and the ability for businesses to get funding?
Thanks. While we see $30 billion of national sales, it's really the aggregation of 38 different state markets, all with completely different regulations, market structures, and implications for operators. So as we see the development of capital allocation to the industry, I think it's much more dependent on the markets that operators exist in and the implications on the structures in those states relative to the actual national basis. So you had your first big capital allocation into the space over the course of 2015 to 2017 in your legacy markets like California, Oregon, Washington. And in all of those states, you saw the same cycle where you built out a lot of demand on the retail side, and you built out your cultivation facilities. And as you continued to grow your cultivation facilities with very low marginal costs, you've suffered from oversupplied conditions. You then had another capital cycle, investing in many of your limited license type markets over the course of 2020 and 2021 into states like Arizona, Illinois, Massachusetts, and those states have now seen the greatest price compression of any markets across the country. Those states are now challenged. We now see this third round of capital allocation, the third capital cycle that our industry is experiencing, where there's 6 states across the country today that are going to contribute more than 70% of retail growth in our industry. It's between New York, New Jersey, Ohio, Maryland, Illinois, and Minnesota. Those 6 states are going to contribute almost 4,000 stores off of a base of just 10,000 today. So as we look at the development of the industry and changes in valuations, it's much more dependent on the states and markets that these operators are located in. You can get a much better multiple in a newer state like New York or a New Jersey than you can in a very challenged market like in Oklahoma, and then how those operators are maximizing that footprint.
So this begs the question, and this is, anybody's question to answer. If I'm lending to this space, is it better risk mitigation for me to diversify my portfolio across multiple states and markets, or should I go deep and know one market really, really well?
Obviously, the answer would be different for different strategies and different companies. I can share the view of SNDL. We actually have vertical differentiation as well as a portfolio differentiation. We believe that there is still a lot of volatility and still a lot of risk in the industry, and putting all of the eggs in one basket is probably not the wisest way, particularly if you're a public company and you need to protect shareholder value. That's why we do have a liquor retail segment, a cannabis retail segment, a cannabis operations segment. We have investments on the US side of the border, on the Canadian side of the border. We think that is the way to go. Obviously, at one point in time, we would start seeing on what direction the profit pools would be evolving. I think it's clear that right now there's more profitability in retail. That's where a lot of people are trying to focus their energy and their investments to increase the number of doors that they have. It's certainly a wise strategy at this point in time. Would it be the right strategy in 5-10 years from now? Maybe it is, maybe it's not, right? If you look at other mature industries, normally retail is not where you have the biggest profit pools. Right. So that's why we think that we have to keep an eye on all of the dimensions that the industry is providing right now, and place the right bets and having the right discipline.
I think for us, just to answer that real quick, I think it comes down to three things. It comes down to asset type and value. It comes down to cash flow and then regulatory structure, right? Because all of those things are going to have a direct effect on that asset's value long term. And that all of those things are going to mitigate our risk as a lender. And so we look very closely, on top of obviously who our borrower is, we look very closely at those three factors when evaluating any type of loan.
Now, Darren, you're lending mostly, I would say almost exclusively to the wholesale side of the house, correct? And that's a little different than what we've heard Alberto and Tyler say, that the focus is on the retail. So what are you seeing on the wholesale side?
We lend basically to the growers. So, again, GrowGen, we are in 18 states right now, so we're pretty diversified. For GrowGen, it's income statements, it's cash flow. And also we're selling products, we're making money both ways. So for us, we understand the customers, we understand the states, we understand where the money's going. And we feel much more comfortable these days right now with groups that have been in business for many years. When you fast forward backwards, 3 years, you were lending to new institutions just coming into the industry that didn't really understand, I think, the nuances. So right now, again, most of our clientele has been with us for many years, and we're value add to our customers. So, we build facilities, we represent the facilities, and we lend to the facilities. And it's a way that we keep our customers happy, and we share in the growth of our customers, and that's what differentiates GrowGen from the other hydroponic stores around the country.
I was listening to Adam at Fund Canada this morning in the opening session, and one of the things he said that kind of struck me was that the alternative lenders have been a way for the cannabis industry to get some experience and show some repayment ability, right? Because it's not like you can go pull a Moody's or a Dun & Bradstreet on these types of businesses. So when you're working with the cannabis industry, do they have to have some other lending experience, or are you focused on things like cash flow and whatnot?
I think for GrowGen, we're probably first in, especially for established groups. What we don't do is usually lend money to new individuals coming into the industry. So, we usually look at groups that are sophisticated, that understand the industry and how to grow. So we're not a financial institution, so, GrowGen is not financing bottom up. We're financing inventory, durable equipments to build out the facilities, the lights, the dehumidification, and everything that goes in within the facility. So, we take a different stance than most of the larger lenders. So individuals can go to a lender, get money to build out the facility, but we put in the nuts and the bolts of the facility. So we'll do the racking to the dehumidification. We are the last mile within the facilities. So we definitely take a different approach.
We've seen a big opportunity over the years with operators that have gone into, let's say, a limited license market, had to acquire a property quickly for various reasons, and they've had to pay cash as a result, because maybe they didn't have access to quick private debt. So we've seen a huge opportunity being able to go in, refinance those properties for those operators after they've showed and demonstrated that they can cash flow those properties. So that's been a huge opportunity for us in this market.
Okay, great. So one of the things that we've seen at GreenCheck is that we're seeing more and more financial institutions, traditional lenders, enter this space. What are your thoughts on what that does to the pricing and the availability of capital?
We're one of those traditional lenders, actually. So I think in a lot of ways we compete with the private market in a very beneficial way to the end user. Obviously, our cost of capital is much cheaper than some of the funds you may see out there, and that's advantageous for everyone. Now, does that mean that everyone's going to qualify to get that cheaper financing? No. And so in a lot of cases, we will actually syndicate or partner with some of those groups to provide either larger debt facilities at a blended rate, or again, to provide solutions for anybody in need of that capital. So I think that the market's getting more competitive. It's going to continue to. It's not only on the lending side, it's on the banking side. I actually happen to think that we will see more banks exit their cannabis banking programs this year than new ones enter for the first time in my 11 years. But again, that's to everyone's benefit in this industry.
Which actually leads to our closing question, and I'd love to hear from all of you on this. Which do you think is better for freeing up capital for the industry, the passing of safer banking or rescheduling? Which do you think is going to help the industry more?
Sorry, I'm hogging the microphone here. I think if safe banking were ever to pass, it would have happened when the Democrats had control of the House and Senate for 2 years. Nothing happened. I happen to be a believer that it will not happen anytime in the near future or the extended future. I do think rescheduling will happen soon, and I think that will have a massive impact on lending because your cash flows are going to increase pretty substantially if 280E goes away. And so for us as a lender, that opens up a whole series of operators that would qualify for those cheaper rates. I also think it's going to compel more institutions to come in to lend, again, lowering that barrier to entry. And I think that's going to be a huge benefit for everybody. But I would not hold my breath on safe, maybe ever.
Certainly, both would be great developments for the industry. It's hard to choose between one and the other one, but I would agree as well with Tyler. We think that rescheduling would be a better solution for the industry or a better choice in this case. Your margins will improve, your cash flow generation will improve. That will naturally attract capital as well into the industry. Now, it's unclear what is going to happen then with pricing. Because the industry could decide as well to now cover the higher taxes that has to pay through higher pricing. It's not doing it for a reason. So once those limitations, they go away for everybody, would we see a race to the bottom happening, like we have seen in some other places? But in general terms, the sentiment is much stronger as well towards the rescheduling.
Thanks. Federal movement and policy liberalization is definitely going to help the industry, like there's no doubt about that. But the problems that exist for operators are a lot more structural. LeafLink has a lending product, and last year we underwrote 570 companies. How many do you think consistently return capital to their bank accounts? 4. The challenges that operators face have a lot more to do with the businesses and operations of those companies than they do with like the policies and regulations and challenges that you get on a federal level. You have extremely low prices with margins that are not sustainable long term. You have poor inventory management practices where operators are either buying way too much product and then have to discount it and lose dollars doing it, or they buy too little and they stock out a product on very high seasonal sales days like 420. And then you also have so many business systems across operators that data doesn't talk to other systems. Like you don't have data piping across the different systems that every single operator uses on a daily basis. So until you start to solve a lot of these key challenges on an operational side, I don't think you're gonna get this huge influx in capital. Like sure, federal policy is gonna help and rescheduling is gonna have a tremendous impact on our industry, but the true unlock is how do we start to solve many of the operational challenges that have not been fixed over the life of the industry?
And I believe that rescheduling will shore up the balance sheets, the income statements of many operators that are out there. It'll bring cash into the industry, which is so important and needed right now. SAFER Act certainly will bring in many more lenders. It should bring cost of capital down. We'll open up Wall Street possibly. But more importantly right now, the rescheduling will, I think, do the job of what most individuals have done in the last couple of years in shoring up the balance sheets. But the money will come in, and I believe if rescheduling does go through, the next act will have to be safer or something with the government changing their stance. So if rescheduling does happen in the next couple months, or even in the next 6 months by the end of the year, I do believe that you will see activity on the other side on the SAFER Act.